Hey everyone, welcome back to my channel. It's Nasdaq with Arshia. Today we're going to be talking about what the Fed Jerome Powell just said. And before we begin, I want to say that I'm not a financial advisor and you should do your own due diligence and research before taking part in any investment scheme. Let's get started. So I'm going to share my screen with you guys. Today's video is actually quite simple. We're just going to be going over some articles and I'm going to give you my opinion on this at the end. So first, the U.S. unemployment rate will fall to 4.5% this year. Inflation will rise, Federal Reserve projects. So basically what happened is Jerome Powell gestured or signaled that interest rates will remain low even after everything fully opens up. People go back to vacations, all the jobs that are still lost are still replaced, all that good stuff. So first off, the Federal Reserve officials expect the economy to rapidly surge towards its pre-pandemic strength, with the unemployment rate falling to 4.5% by the end of this year, and inflation surpassing the Fed's 2% target, according to projections released Thursday. Now, Fed officials anticipate that gross domestic product, or GDP, could grow 6.5%, the fastest since the 1980s. Inflation is also projected to hit 2.4% by the end of the year, a marked jump from the 1.8% projection in December. A growing number of Fed policymakers expect the economy to be healed enough to begin raising interest rates from near zero in 2023. And at a press conference on Wednesday, which is today, Wednesday, March 17th, 2021, at the time of recording, Federal Reserve Chair Jerome H. Powell said that some measures of economic activity and employment have turned up thanks in large part to more widespread access to the coronavirus vaccine and additional aid from Congress. Also, the S&P rose today, again March 17th, 2021, it's a Wednesday, recouping an early loss after the Federal Reserve's late predictions shows that the central bank's policymakers don't anticipate an increase in interest rates at least until 2023. Just 7 officials penciled in rate increases by the end of 2023, while 11 saw that the policy tool remained on hold. The Fed is also buying $120 billion in bonds per month and $80 billion in Treasury securities, plus $40 billion in mortgage-backed debt. Jerome Powell, the Fed chair, indicated on Wednesday that the Fed was not really ready to even start talking about when it might reduce that support. "We'll be carefully looking ahead," he said. "When we see that we're on track, then we'll say so, and we'll say so well in advance of any decision to actually taper." So what their predictions basically are for 2023, by the end of 2023, they're predicting now that the price gains will rise 2.1%, and at the same time as unemployment will fall further and more quickly. And as we all know, markets have been really jittery in the recent weeks, and the fact that economic outlook is improving and concern that inflation might shoot higher have pushed up rates on longer-term Treasury securities. And that has at times caused stocks to swoon. Share prices tend to fall as interest rates increase, though key indexes remain near record highs. But on a side note, 90 million stimulus payments have gone out, according to the U.S. Treasury, which could mean a rise in inflation. But what he's trying to say is that the inflammation and inflation in the market will only be temporary, and it'll go back down. Which I personally find that can't be really true. But the S&P, on a side note, rose 0.3%, reaching a record, while the Dow Jones Industrial Average rose 0.6% and the Nasdaq Composite gained 0.4%. And volatility in stock markets has subsided from either in the month when the bond yields jumped higher at the rate that took investors by surprise and caught the attention of central bank officials. Let's move on to our next article. So from the New York Times, Fed projects patience even as economic outlook brightens. So the main thing, what Jerome Powell said, he's estimating the show rates at near zero for years. So he's not predicting anything great. He's like, I have no expectations for this. Also, he also predicts faster growth and higher inflation. Federal Reserve officials signaled on Wednesday that they're in no rush to dial back support for an American economy still struggling amid the pandemic, releasing a fresh set of projections that showed the central bank's policy interest rate on hold at near zero for years to come, even as growth is expected to pick up considerably in the near term. The Fed slashed its policy interest rate, which guides borrowing costs through the economy, to rock bottom in March 2020 and chose to keep it there Wednesday, an effort to keep credit cheap and continue stoking growth. Analysts have expected the steady outcome, but we're closely watching the central bank's fresh set of economic projections, which show officials' anonymous estimates of how conditions will evolve through 2023 and in the longer run. The new release shows that officials have become more optimistic about the outlook for growth, unemployment, and inflation since their December estimates came out, but not to the point that they anticipate a wild overheating of the economy or expect to remove policy support rapidly. And what Jerome Powell also said, no one should be complacent and the path ahead remains uncertain. So really, he says that we're still struggling, even though if it's much better. And he really doesn't expect the unemployment rate to not remain elevated because millions of jobs are still missing. And also, he's really uncertain to say about ahead. And also, they said in the policy statement that indicators of economic activity and employment have turned up and recently, although the sectors most adversely affected by the pandemic remain weak. So, in conclusion, we still have to see growth. There's more growth left, and we haven't completely healed yet. But also, he says that interest rates are going to remain low because we are still in the phase of growth. Mainly, I think that interest rates are going to rise because we are still reopening, but they're going to rise as we reopen more and more. So thank you guys for watching this video. I hope you enjoyed this video. And if you found this information helpful, please give a like, comment, subscribe. See you in the next video.